again, why we like the small cap space is, again, first and foremost, very undervalued, significant asset in the ground, and a lot of times you'll see these companies talk about billion-dollar NAV, but they're trading at 5 to 20 million market cap, which makes no sense. I mean, how is it so cheap? And the reason why is it takes a lot more money to develop these assets. You're not talking about building a convenience store here. You're talking about building something at a few $100 million market cap. Oftentimes, you're looking at countries that are not your backyard. We're not doing this in Texas. We're doing these things in Mexico, in Nigeria, in Burkina Faso, in Africa, worldwide places.
All right, we were back with our next guest here in a moment. It is the Jerry Huang show. He's going to talk about sharing trading collar systems. One of the smartest guys that I know in finance. Let's go ahead and bring him on now. Jerry, you're on stage. How are you doing today?
Hey, pretty good. Hey, Rob, how are you? Thanks for inviting me. Always a pleasure. Wasn't very long ago where we shared a stage last week with a company that was putting out a significant amount of dividends. So that was great to have you on the China Gold webinar. I'm just trying to find where I can share screen log.
China Gold. Yeah, I'll talk about China Gold while you get the sharing up. China Gold International was just one of these companies we covered
way
2 or 3 years ago, I think.
Yeah, 2.5 years ago. That's
yeah,
right.
and they had distress with the debt situation, where people thought they had distress with the debt situation and production, but they recovered all of that. Now the stock is like 5 times what it was when we covered it.
Yeah, I think it's like 700% return. So, but yeah, no, I mean, great speaker earlier. Steve's pieces are great. Financial planning. I mean, I started off as a financial planner before going into banking and mining. I'm just waiting to load the presentation. So while we're waiting for that, I mean, I can talk about maybe a brief background about who I am if we haven't seen that on the bio before. My name is Jerry Huang. I've been working in junior mining now for about 13 years, mostly for mid-cap and small-cap producers, developer resource companies that have assets in the ground. So I invest myself. I grew up very humble beginnings with parents working 9 to 5 and work in the retail bank. I've done some real estate investments and development deals through our networks. I'm based in Vancouver, in Canada, but I travel very often to the US. But how I fell into junior mining was that this was a very interesting space. I basically learned from some of the biggest names in the sector. We're very fortunate to have them as banking clients. When I worked at CIBC, one of the larger banks in Canada, Ron McEwen, you have Lucas Lundin, the Lundin family. Many of these companies, you would see them on NYSE and billion-dollar companies, but they started off very small, a lot of them. And that's, I think, what the opportunity, as Steve had mentioned, and some of the previous panelists did was, and Rob mentioned, these companies don't start off huge. I mean, you're starting off with oftentimes a hole in the ground, geological beginnings. But at the same time, what I want to talk about today is this trading system, collar and puts that you want to have in place for your downside protection, because the volatility is very big, and the swings can margin you out, especially in this time period we're seeing right now, where the volatility VIX index is very high. So again, Jemini Capital is my own advisory company. We have a handful of clients that we also invest in. I think we invest in 90% of our clients. We help them with the social media, capital, introductions, and we ultimately help them grow their company. So if you're interested in small cap stocks and in ideas, I'm happy to put some thoughts for you. Again, why we like the small cap space is, again, first and foremost, very undervalued, significant asset in the ground, and a lot of times you'll see these companies talk about billion-dollar NAV, but they're trading at 5 to 20 million market cap, which makes no sense. I mean, how is it so cheap? And the reason why is it takes a lot more money to develop these assets. You're not talking about building a convenience store here. You're talking about building something at a few $100 million market cap. Oftentimes, you're looking at countries that are not your backyard. We're not doing this in Texas. We're doing these things in Mexico, in Nigeria, in Burkina Faso, in Africa, worldwide places. Governance-wise, I mean, you need to look for strong boards and well aligned management. So again, there are a lot of risk and uncertainties with a lot of these companies. I mean, they often are not going concern. So on the accounting side, I'm also a CFO and consult for a few companies. But that means that these companies have no definable cash flow. They're not going concern operations. Oftentimes, that means they need to raise money from the market every year, every few months to keep their progress and keep the momentum. Pricing wise, I mean, you need to look at the pricing in terms of what the market is going. These are, again, I mentioned, these are often thinly traded stock versus your Tesla and Twitter of the world. So you need to look at the pricing versus the 50 moving day average, 200 plus moving day average, and guys like Dave and Morgan, who obviously covers silver for years, are perfect for that. I mean, they know how to price these things, and a lot of times these newsletter writers have much more insight than most major banks would. And lastly, you need to have this protective moat, either GTC, good to cancel sell order at your target price, or some sort of a downside protection on shorts if it's coming up before free trading. For US investors, you're often looking at about a 6-month legend removal, meaning there's a hold. Right, once you buy into a deal on a financing, even though you get a warrant, you may not be able to sell right away. So you need to protect yourself in that. I mentioned earlier that inflation is coming. This is quite clear. I mean, we've been saying this for years. It only took COVID, it only took natural disasters, and now a war in Ukraine and Russia to really wake the market up to something that's largely in front and center to us every day. You look at the VIX on the bottom. This is kind of the broad index that we all look at, whether small cap or large cap. You can kind of see it really just nearly doubling in the last month from the beginning of the war or so. And again, this is not even the historical high. We've seen it as high as the 35.40 during the financial crisis almost 13, 14 years ago. So we're in for a ride, needless to say. I mean, look at this return. This jump is up 71%. This is representative of the wild swings. So what do you do when things are swinging? You can still make money. As Rob and many of the other day traders have said, swings are great. I mean, that's what you want. You actually want a market that's moving. But again, obviously, that's even better if you have some sort of downside protection or an upside call option. So just kind of going back to the original intent, what is short selling? We hear oftentimes in the broad market, on CNBC, Acker Finley and Bill Ackerman selling, short Herbalife, selling short Tesla. Bill Gates was short Tesla on his private conversation with Elon Musk a few days ago. So short sellers generally have a bad rep. You're kind of betting against the business. You're essentially selling short at a certain price, and you're kind of profiting from the eventual outcome. So you're selling at $10, and then if you believe it's going to go to $5, you buy it back at $5 and pay it back. Right. So it's simple enough. The very simple logic there is that you believe something will go down. So rather than buying a stock which you believe will go up, being long, you're short, right? So you need to find a bank that has that. There's naked shorts and all that. We don't need to go into that for the sake of this session. We go into options. These are derivatives. What that means is that these are non-tangible assets. So what is a derivative? Derivatives essentially are contracts, right? So these are contracts that have no tangible value except for the fact that you're buying essentially you're essentially buying a derivative to basically buy back or sell at a certain price. So it's a right for you. So if you look at shorting the stock, you have essentially a full downside risk and potential to gain if you're right. On a long call, you basically have a cost, and then it basically, if you go up, so that's why the drop here, there's a cost to basically these options, right? You're writing the option, you're buying an option, so it'll cost you a few dollars. If the stock's at $1 or $100, the call option, the short option, would probably cost you $2 or $3. So look at it as an insurance, either on the long side or the downside. And why this will be useful in a small cap fluctuations stages is that these allow you to have that downside or upside call option, even though you might be long the stock or short the stock already. These are essentially a way for you to collar in and protect that range. So we'll go into the protective collar option. We won't go into too specifics because obviously time constraints, but essentially with a protective collar, just like the name suggests, you have a put on the strike price and you have a call on the strike price. So that really gives you a narrow range. So if anything, that kind of limits your upside or your downside, but kind of it limits it both ways. This is generally not, I mean, for me at least, we don't see it too often for most small caps, but I think most small cap guys are quite simplistic in the way that is largely a market short, and then you're long for the majority. So the market short really is the way to just limit some downside. But most of the industry guys, once you're convinced of a certain position, most of the time, most of the money is made on the upside, not on the downside. So I will put that out there. But again, why do you need these options in the small cap space? As I mentioned, this is a blow up of the previous VIX slide. It's really a magnified volatility on these small cap names, right? Not only are you dealing with broad cap, headline figures on inflation, on the war, on gas and oil and gas supplies out in Ukraine and Russia being afflicted. It's even magnified because small cap companies, a lot of them don't have cash flow. So you need to go back to the market, which is on this end of the scale. It's really high risk venture capital. You're not dealing with Goldman Sachs that can raise $500 million in a day. You're dealing with companies that that probably needs a few weeks to put together $2 to $5 million financing. It's often called best effort, right? So on this end of the scale, your volatility is much even higher. You have significant holding time frame, which anything can happen. And lastly, you're dealing with mostly technology, early stage companies that are also working towards a certain milestone, or even against a certain commodity price that's fluctuating daily. So having some sort of downside protection, great insurance, well worth the price. Even shorting it ahead of a certain milestone, it might limit your upside, but it's going to certainly protect you on the downside. And right now, one thing we can all agree on is volatility is very, very high, and it's going higher. Why mining, and obviously why some of the major miners? If you want to keep it simplistic, �GDXJ, this represents probably a lot of the top 40. This chart is from PwC, one of the big four audit accounting firms in the world after KPMG. And this kind of gives you the combined 40 largest gold miners in the world. And this is very recent. This is within the last 2 years. And you can kind of see why. I mean, producers are outpacing S&P and TSX Composite on almost a scale of 50% plus. And that's quite clear just in the last 2 years, because we see everything in our life getting more expensive, right? Copper is at nearly $5. Lithium has gone up 800% in the last 4 years. Silver has done well. It's pulled back recently, but again, it's still probably nearly 60% up from when we talked 2 years ago. Me and Rob was hanging out in Mexico back then at $17 silver. $24, still pretty good, right? I mean, hit 32 last year this time during silver squeeze. And again, obviously, this all passes down to the producers who have actually cash flow. They're producing it. They're price takers by the economic sense, and without affecting their operations, other than energy input costs, they're making now almost double what they are making versus 2 years ago, and when copper was at $2. So all free cash flow, all going down straight to the bottom line. So it goes without saying, commodities is definitely where you want to be right now, especially if inflation is continue to go. The simple slide from US Global, great presentation. I mean, a lot of times when I work in banking and real estate before, people ask, why do you need commodities? I mean, just look at this figure. Every baby within their lifetime needs a few hundred pounds of zinc, clay, salt, almost 1,000 pounds of copper. Copper's at $5. That's $5,000 right there. Each baby, each person, right? There's 7 billion of us in the world. And if you do the math, I mean, obviously this is a much higher standard and quality of life for a typical North American baby, but we need to find a lot more of these things. So these are the narratives we're working against, and it's not going to change. It's even going to be more expensive now that inflation has really, in reality, has set in post-COVID. Household debt is increasing. I mean, post-financial crisis, don't need to tell you that. Leverage and percentage of GDP to the household debt, we're almost looking at 80+% after 2018. Again, $20 in 2000 versus $20 in 2021, 2022. This puts it right there, right in front and center. The inflation rate, we all know it's not 2%. It's right now at 4, 5, month to month is going up higher, right? Like the CPI is going crazy. Our dollar certainly doesn't go as far as we used to. So whether it's real estate, mining, GDXJ, silver, anything that outpaces the decay of cash and the value of cash and purchasing power will at least put you ahead and protect you, right? So we're not endorsing just junior mining and junior tech and development companies, but anything that you believe has solid tangible value, especially at depressed prices, should at least put you on par with inflation. again, this is a rise and fall of dollar. We've seen this, posted this before in the last 100 years, plus since 1913. We've seen just purchasing power fade and fade and fade. And again, the ship has really set a sail. It's gone too far for too long. It's certainly not going to change. So all we're trying to do here is to really educate and try and find opportunities that would at least protect our family and our purchasing power. So again, just a few ways to invest in mining. I'll talk about the collar and the pricing of the 50 moving day average and 200 moving day average in a bit. But again, some of the main ones that PSLV, GDXJ that Steve mentioned. So these are the large cap mining gold ETFs. On the large boards, these are the easiest one to go for. Super liquid, you can get in, get out. They're very representative. You have no inherent geographical risk. They're very diversified. You're buying the Barrick and Newmonts of the world. You go to the physical metals. Obviously, the storage is an issue. The security is an issue. Again, also selling it and utility is a bit of an issue. I mean, you go to the corner store to buy a bag of sugar. How do you shave off a few ounces from your gold bar or your gold coin to pay for that? And that's obviously the fractional division is of Bitcoin, cryptocurrency, and even stable coins backed by gold, backed by US dollar. That's kind of where that comes in, that convenience and utilization and fractional values. And lastly, you can also invest in mining companies, whether majors and startups and ventures. Really pick your flavor, pick your poison. I'll just really quickly go over some of the options we talked about earlier. So the Spider Go share, last 2 years, going back to April 2020, 75% up, 30% down, right? So at the right opportunity, you can definitely make a lot of money. And again, once you're in profit, again, no specific financial advice. I'm not a licensed financial advisor anymore in Canada and US. So again, no specific trading instructions, but there are ways to obviously time these things, whether by a short strategy or by at least a put option where you are 90% long the stock, but you have a portion of the value buying in insurance, right? Or even a good to cancel, very simple sell order. You have a target price of sell, automatically it sells. It's good until cancel, so you can have that peace of mind that once you've written this up, you're up 60%, let's say. I mean, if you're down 20% on a single day, you have a sell alert, right? Simple things like that. It doesn't even matter if you don't have a complicated collar strategy to protect your gains. Even on something that's liquid as GDXJ, you can do that. Physical gold, you can kind of already see back to back, 18% up the last 2 years, 8% down, right? So relatively speaking, gold itself, the physical asset, hasn't done as well as the miners, and you can kind of see why. I mean, you're buying an ounce of gold here for $2,000 or an $1,800 right now, versus you're buying a basket full of quality miners that make crazy cash flow, trading at 5 to 10 PE, right? Like profit or price to earning ratio that Rob's talking about. On average, S&P is going for about 28 right now. Forward looking PE, even higher on NASDAQ because tech firms have just run crazy. I mean, Facebook usually trades at 35 to 40 times PE, right? So tech firms, because of growth, they have much higher valuation. It's completely the other way for miners and broad-cap miners. You're trading at a single-digit PE in some cases. But again, physical gold, 18% up, 8% down. On the downside, there's GLD, there's HUI, there's some various instruments you can also use to buy and have a portion of your portfolio in physical gold as well. Specifically on some of the past positions we talked about, I think probably last September on Rob's event, NAV Gold has done really well on the upside. I mean, the financing was at 40 cents. At one point, it hit 80 not too long ago in April 2022. Bit of an update is obviously down with kind of the risk sell off recently, but you can kind of see. I mean, on the upside, even on a small put option or a call or short option, you have done very well. I mean, you're up 200% plus. You're down 25 right now. So in the grand scheme of things, again, this is a fairly new company, ex-Nevada Copper team. Brandon and his team very well healed in the capital market space. Good asset, just starting off to explore in Nevada, obviously, Nevada Gold. So right in one of the best places to be in US. But here's where you can see that if you get in the right place, and this is just an IPO, straight IPO, brand new company. So none of us have a prior knowledge of it. We like the team, we like the companies, and it's done really well. kind of a revisit of a uranium name. Uranium has done really well too. Again, this was from late 2020, so it's been about a year and a half so far. It's continued to perform well. It's still up almost 100% from our entry price, but 500% return, down 80%. So it depends on how aggressive you want to be on your collar, on your target price. And again, if you have a good to cancel order, once you're up to 300%, if it drops 100% or it drops 80%, 50% down, immediately sell it. Or if you have a call option or a put option strategy, that enables you to protect that swings. And I'll just explain a bit why this has even dropped in the last few months was actually because of a uranium newsletter that a lot of us all know issued a sell order on the back of a copper price, copper project update with Rio Tinto. So the company is very well heeled in terms of joint ventures with majors, both with one of the largest uranium companies in France and also with Rio Tinto, which is probably one of the top 5 largest copper producers globally. Even though this is a uranium name in Saskatchewan, which is kind of where NextGen and all the major guys are, Denison mines and everything. And we all know uranium is doing really well. Clean energy is one of the best and most efficient ways to produce energy. These guys are down almost 80% in the last half a year, really through no fault of their own, through basically just a mismatched timing, tax laws around the end of the year, illiquid markets, risk off mentality. But you can kind of see, I mean, from December 2020, this financing and warrant, it's done phenomenal. I mean, it's up 500%, down 80% recently, but still up overall. So again, the right collar strategy can really just enhance and protect your gains in this way. FireWeek, we follow this from IPO. Brandon, again, another Brandon, and in Yukon, excellent project. PEA continues to attract financing even in a tough market. They just closed about 13 million. The IPO was at 50 cents. At one point, this was $1.20, $1.50, I think, in the Canadian market. So you're 200% up, 48% down. Okay, you can kind of see a trend here. If you pick these companies well and enter at the right price, again, you're still at a very reasonable entry point, and you can still get out with decent liquidity. I'll jump to Santa Cruz. Again, similar story. I mean, these are not one-offs. This is a good silver company that we all know in Mexico. They've actually just closed $110 million project in sort of Bolivia with Glencore with no cash down. So again, the stock has done phenomenal. The pricing of the placement in 2020 was 22 cents and 30 cents 3-year warrants. It's currently at 45 Canadian, and again, it's still up. Again, at one point it was up 400% with silver squeeze last year. Get 25% drop, nothing too bad to consider in the grand scheme of things. Lastly, Impact. I mean, obviously, it's done really well. One of the purest silver producers out there. Net cash, no debt, profitable. But it's trading at 50 million market cap with about 22 million in cash and no debt. So from the beginning of COVID, at I think it was 20 cents to $1.20, right? 160 plus gain, down 50%. Catalyst coming in 2022. Again, it's an easy buy at this target, I think. I mean, gold silver ratio, we all know, is way out of whack. These guys produce about 800,000 ounces a year. I'm the CFO here, so we know the company very, very well. We're all big investors in this one. Management has about 10% of the company. Lastly, Borrow Gold, similar story. I'll jump to the Nickel North financing, which is currently live. Again, we're looking at a potential financing here with a nickel asset in the ground. Very low valuation, 4 million market cap, 80% owned by insiders and management. But yeah, it's again, why small cap? I'll just kind of jump to the end. I know we're running a little short on time, but again, significant returns are in small caps. Managements are, if you find the right ones are aligned to the values and everything else, you can do really well. You got to be selective on assets, so pick something that you believe will work out, because these are diamonds in the rough. Oftentimes, they are cheap for a reason. One mine out of 100 or 150 prospects, like a narrow pyramid, gets through to development, gets through to production, right? So it takes a while. Catalyst to invest for, you have to look at, you have to look for drilling, joint ventures, resource. So again, in addition to the trading volume and the market timing, and really the moving averages. You also have to look at news flow, right? So small cap companies are even more affected. The major Twitter, Facebook, Microsoft earnings is this week. Though if they miss by a penny or two on that, I mean their share price can move 3%, 5% on like a $40 billion company. On a small cap, you're talking about 10, 50 million, $100 million companies. On drilling results on a joint venture, they can jump 10, 15% or 50%, right? So again, you're looking for an exit, you're looking for a target price. You want to plan your collar, your sell puts accordingly. So again, that's my quick presentation about Gemini. My own holding firm. We invest in 90% of the clients that we work with, partners that we work with. Happy to take some questions. These are some of the financings and deals we've participated in, invested in ourselves. Sorry if I went a little too fast, Rob, but happy to take questions.
Yeah, it's great information, and thank you so much, Jerry. You always pack your presentations with so much, and I appreciate it because I know you have just a wealth of knowledge of being in finance for so long and being in the mining industry. So a great asset to have.
Thank you.
I wanted to chat just real quick about China Gold International because we talked about them last week.
Definitely.
That was a company I covered on Seeking Alpha a couple of
Yes.
times, 3 or 4 years ago. You turned me on to it.
Yep.
They had some challenges. They worked through those challenges. The big thing was sometimes companies have challenges, and the value that you're going to get as an investor is in them addressing those challenges and bringing that to market. So if you could talk for just a second about that, just because a company's not doing well now doesn't mean it can't do well and turn around operations.
Yeah, so China Gold is much more of a special situation. It was actually a Robert Freeland company way back when, about 12 years ago. So it's come from very big names. And again, it's 45% owned by the China National Gold, which is the largest producer of gold in China. So it's got about 3 million ounces a year production. I think last year they produced 190 million pounds of copper, which is significant, and then gold, right? But their cost was higher. They operate 2 major mines in Tibet and Inner Mongolia. So up until 6-7 years ago, Tibet was pretty controversial, right? So we won't go into some of the humanitarian and topical issues there, but operations is fine, is very much controlled and stable. So there is that certainly jurisdictional risk. But where that opportunity was last year or 2 years ago, Rob, was that China Gold had about $1 billion in debt. So again, on the face value, I mean, back then when we looked at it at, I think 40, 50 cents, JNFF, 460 million shares out. So it's a 40 million market cap company doing about 450 million a year in revenue, right? It was actually a crazy value. They were doing 250 million in EBITDA, right? So they're trading at 1x EBITDA, right? Or less. On an enterprise value, it'd be a bit higher. But I think what the market just weren't able to wrap their head around was how did a company that's at 250 million market cap have $1 billion plus in debt? But the debt was, you have to look into the specifics. It's triple rated B on S&P and Standard & Poor's. It's unsecured, and I think it was at 2.2%, right? So they ended up renewing it in July of 2020, and the stock just took off. I think last week before the ex-dividend date, they're putting out $100 million dividend on $350 million net income, right? They're putting out a third of it, paying back to the shareholders, of which the largest is the largest miner in China. So I think the opportunity here that most banks miss, and they don't have a lot of Wall Street coverage, even though it's a $1.5 billion market cap company today, because they never really pay the streets, right? And that's something that Steve also mentioned. Sometimes Wall Street doesn't have Wall Street typically does not have your best interest, right? I mean, we all saw from Robinhood that the Citadel Capital actually is the largest shareholder of Robinhood. So when you think that Main Street and Discord and Reddit was taking the screws to Citadel, at the end of the year in 2021, Citadel made net profits. Right. So it was very short-sighted. Main Street screwed Wall Street on GameStop and AMC. Yeah, but they have 1,000 other positions, and they also own the platform that sells your trading flow back to the hedge funds. So they're front running against you. So anyways, it's a long-winded answer on that. But
yeah, it's good to know. It's good to know who's main, and that's something I'll talk about real quick, and then we've got one question, then
Sure.
we'll pop off.
Okay.
So that's one I learned from working at FXCM. They said it was a currency broker, and I was in support, right? I was in supporting all of our clients and had to get my options license for that. And they said we never trade against our book, but you have to watch out for who's got your money, because they did trade against their book. They got busted for it. And a lot of times you're going into an app. You have to understand development of an app and development of market takes money. There's going to be some big players involved, and understanding the ownership of that. That's just one word of caution I'll put out there. Just because you think you may be fighting Goliath doesn't mean that Goliath is not running the game, just in a different format. And you're really, playing into the hands of Goliath. So just be careful. And it's always good to be activist in your investing if you want to be, but just be careful and who you're actually enriching when you do that. So we had a real quick question from Ralph Potts. I'll put it up on here. He says, can you cover making passive income from trading options calls? Meaning, is there a way using options calls that you could generate some passive income for somebody, maybe as they're getting to the end of their, maybe they're not working anymore, they've got time to put into this. Is there a way to do that?
I would say generally, Ralph, that anything that is derivatives involved, you have to be pretty active. Like I think anybody that's promising, hands off, like Amazon drop shipping, you just have to like make some websites and generate some leads and everything's automated. You got to be a little careful with. I mean, the thing with even short selling is your loss is unlimited, right? Like it's, I mean, if the stock goes up, and rather than going down, it can go to $1,000 from 10 cents. Like your loss is unlimited, right? Like I don't know of specifically any passive strategy for that. I mean, in terms of passive strategy, I mean, buy and hold is probably the easiest one. Buying and holding, maybe a large cap miner like Newmont or even China Gold that has been paying out 3 to 5% plus in dividend, and then having some downside protection, right? Like what we covered earlier. I mean, China goes at I think $4 a day, so you have a downside protection that you have a put option, or you have a good to cancel sell order at 380, right? So you're or even a closer stop at like 395. So if you're at risk of losing your dividend as a passive investor, right? I mean, if you're on fixed income retirement, you don't want to lose your principal. I mean, even for Bank of America, you can do that for Citi, right? Same idea. That would be probably a more appropriate passive investment call for someone at your KYC, at your life stage investment horizon, right? I mean, you buy a Citi that pays out a yield of 4 or 5% plus some capital gains. Maybe your all-in total return could be 7-8% on an annualized basis. So that's kind of what you're risking, right? So if you put in $100, let's say your price at $100 for Citi stock, you would have a good to cancel sell order at like 94, or 95. It drops it to that. You're kind of risking more than what you signed up for. Then you get out.
Gotcha. Jerry, I think that's going to be it for us today. We got a couple more questions, but we're going to ask him in the next segment because we're running into our next segment. Thank you so much, Jerry, for joining us. Principal Jemini Capital, CFO, Impact Silver. How do people reach out to you, Jerry, if they have more questions specifically on some of the stocks that you mentioned?
Sure. Always, yeah. So on Twitter, we're easy to find. So either at Jemini Capital or Capital Gemini. We have the US and Canadian account. Impact Silver is at IPT_silver. Ticker is IPT on TSX, ISVLF on the US.
Thank you so much, Jerry, for joining us. Always a pleasure to have you on the program.
Thank you, Rob.
All right, everybody, that was the end of that segment with Jerry. We're up next on the table of Titans. I think we've got everybody just about ready. I'm going to bring them on one by one and introduce them, and then we're going to get into our